Hey, good morning, everyone. Marty Missouri here. Wednesday, June 15th, 2022, early in the session, hour and a half after the open, with your midweek market technical snapshot. So, folks, I've been spending a lot of time on the written blog this week talking about the Fed meeting that's wrapping up today. We're going to get the rate decision, markets anticipating a 0.75% increase in the Fed funds rate. I don't want to get into that here on the video because I've done so much of that on the blog, and clients really want you taking in both the written blog and these videos, but I'm trying to keep these videos short, but I do tend to ramble on about things like Fed meetings and lately about the underlying dynamics around options exposure and how I think that is very interesting and short-term, potentially meaningful for stocks. And when you get your head around what I'm talking about in terms of the hedging on the part of the dealers and the covering of their own hedges, their short positions, there's a potential for something special, however short-term, for the market to the upside, right? And we need to be very cognizant of the dynamics underneath the surface because of the potential signals that many folks will misinterpret. I would suggest that a lot of folks will view that rally, if it comes, later this week, early next week, as, look, it's, the market's bottomed, the Fed did this big rate increase. That means, the worst is over, that it's going to do the job on inflation, yada, yada. You're going to hear that on CNBC and other financial media outlets. But in reality, in the scenario that I've laid out, it's more just the expiration of options, the gamma exposure, as we call it, to the options dealers, and then the unwinding of their hedges. The market is very dynamic, and as one technical analyst who I have a great deal of respect for says, so must be our analysis. So without further ado, you're looking at the 60-day, 60-minute chart. And we're seeing a pretty nice rally this morning. It's given up some of its steam, but the S&P is still up 93 bips. The NASDAQ 100 is up 144, almost a percentage and a half. Yesterday, the charts were beginning to sniff this out. Here we are building a new falling wedge pattern and bullish divergences on the momentum indicators. Now, this pattern right here is not in and of itself a buy signal. The buy signal is when we break out. Of course, we broke out. Big gap up today, and you can see that it, to some degree, it's given up the ghost. This Bloomberg chart is a 15-minute delay, so we're coming back off of these levels here as I speak. So yeah, this ultimately on the very short-term chart has some promise, and like I keep saying, we actually still maintain that a big, strong bear market rally could take us all the way back up to these levels before we ultimately come down and get to some sustainable lower low. No certainties there. Certainly there's going to be some real resistance along the way if indeed we do get that kind of rally. And I think there's the potential, there's kind of a coiled spring. Certain Fed decisions, the European Central Bank is active this morning in terms of meeting to discuss, quote, market conditions. The Bank of Japan could move the needle for sure this week as well. So yeah, there's some potential catalysts in a market that's down a bunch. Let me add one more point. I was thinking about this as I was driving home last night. We can sense, certainly you can see it in the sentiment surveys, that people are very, very nervous. Few clients are beginning to wonder, hey, I'm getting scared. I'm hearing a lot of the news and so forth. And I was thinking to myself, how ironic that when you go back, and let's go ahead and go to the daily chart, even the beginning of this year, well into last year and so forth, here we are at all-time highs. And you can ask yourselves, was I feeling more comfortable here than I am right here? Here we were at all-time highs, price to earnings multiples at scary levels relative to history, price to sales, you name it. The Buffett indicator, the things that we talk about periodically, are all at the kinds of highs that tend to see markets collapse at some point, off of those levels. But by and large, sentiment was a lot better. I can tell you that from our indicators back in here. And here we are in the S&P in a bear market, 20+% lower, NASDAQ composite down over 30%, lots of stocks down 50, 60, 70%. And more reasonable price to earnings ratios, and other valuation metrics relative to history. And folks are, maybe freaking out a little bit emotionally here when stocks are cheaper, as opposed to how they felt when stocks were way up here, with the characteristics that I just mentioned. Isn't that kind of ironic? I used to always preach, I was parroting someone, I'm sure, stocks are the only things that nobody wants when they're on sale, right? They want to buy cars when they're on sale, yada, yada. But when stocks go on sale, they want to sell them. And when stocks are super expensive, they want to buy them. And that's just kind of the nature of, what stocks represent, optically in our portfolios and our retirement plans and so forth. But really, when you think about it, you just break it down to, okay, do I want to own stocks at, 17 times earnings versus, say, 20 times earnings at all-time highs, or 20+% off of all-time highs? One would think that you'd feel much more comfortable owning them here, right? But that's not the case. I know that, and I can sympathize with that. But when you stop and you just take a deep breath and you get calm, you think, if I just woke up today from a 5-year trip to Mars, or I just got home today, or I woke up from a coma, or what have you, the scenario I want to be in the market with, well, I'd actually probably choose this scenario. Cheaper stocks, cheaper multiples, and so forth than this scenario. So anyway, you get the point. Moving on our daily chart here, we broke down. I actually thought that right around 38.15 or so would be some meaningful support, and we cut through that like a knife through butter. Keep in mind, again, I maintain that all this options, all this gamma exposure in there, the options dealers, has had a not small impact on this. They're so exposed here at certain levels, and when the market breaks down, they have to continue to short the underlying securities, and that just adds serious fuel to the downside pressure. So where I was expecting to see this bottom right here provide some meaningful support and bounce off of that, I think that's one factor. Could have been margin calls where folks had to unload securities as well because they dropped so quickly, but I do think that's one factor. So here we are finding some support down in here and about to test this level. If indeed you get something market friendly from the Fed, or that's deemed market friendly, and then you get all that covering of all those shorts, you get cut like a knife through butter to the upside before meeting some higher resistance up in here. So very dynamic market from the way we look at things technically, right? So you do have, if I were just to extend this downtrend, you can see we've tested that, and it's held so far as support, right? In terms of the momentum indicators, you could argue that now that the RSI is turning back up from nearly oversold levels, that is, bullish divergence. If we do get a rally here and this, turns upward, then you're going to have something like this, and you're going to say, oh, there's a bullish divergence, right? A lower low on the price, higher low on the momentum indicators. Keep in mind, though, that in and of itself is not, a buy signal. You've got to get a meaningful breakdown, from some lower trend. We'd have to draw a pattern before it would be a buy signal. So again, these just point to probabilities going forward and where the pressure is building or mounting. So all of that remains to be seen. This is a crazy volatile week, no ifs, ands, or buts about it, as we get the Fed decision and these other things that we've been talking about. So when we jump to the weekly chart, and I have, I think, spent enough time in prior videos on the history as to why these are our levels right here technically. We've got another 7 or 8% to go before we get to, we think, a potentially meaningful bottom. And on the monthly chart, it's, of course, virtually the same spot. Takes us down another 8% or so before this shakes itself out. And that amounts to about a 30% decline for the S&P. Now, there's something very empirical about this, given the overall setup and the technicals and how the market has reacted over the 30 years. But keep in mind, we have one huge factor, and that's inflation, the likes of which we haven't seen in 40 years, which is doing a number on markets, and of course on sentiment and on Fed policy and so forth. So again, very dynamic. So we have to remain dynamic in our analysis and continue to hedge the best way possible against something further to the downside, and be prepared to take full advantage of the opportunities that always emerge amid bear markets. So folks, I think that's enough for this midweek update. Sure to appreciate you watching and listening. Stay tuned. It's going to be quite the week, and I'll be back with the morning note, and then tomorrow and then Friday with both a macro update and another technical look at the S&P 500 at least. Take care. Have a great day. Bye-bye.